Welcome back. Amazon kicking off the holiday shopping season this week with its Prime Big Deal Days, but some shoppers questioning how valuable the bargains really were. The Washington Post says some items actually increased in price compared to the week before, and others that were marketed as discounted hadn't actually changed in price at all. Joining us now is Evercore ISI head of internet research, Mark Mahaney. He has an outperform rating and a $280 price target for the stock. Mark, I'm sure you did way more channel checks than I did here, but I did put an item into my cart, and then a few hours later, the discount disappeared. It was just kind of regular price again. But just broadly speaking, what do you think this means for the brand promise that Amazon offers its customers, and does it degrade that trust a little bit?
Well, I guess it could. We do our annual surveys on Amazon, and when we did it about 2 months ago, it actually reached record high levels for us in terms of in terms of where people like to shop online, and we test things like brand strength, price, selection, and convenience. So I haven't seen any change there. I read that Washington Post article this morning. I thought that was pretty negative. A little skeptical of the conclusions, but I don't have anything better. But the channel checks that we've done on the Prime Day over the last 2 days, yeah, it did come in a little bit kind of soft or a little bit light. Now, you have to compare that with the 4-day Prime Day that they did in July, so it's hard to compare 2 with 4 days. And it's possible that it reflects a little bit of consumer softness. It's possible that's in there. So it's hard to know. But yeah, I don't think it certainly wasn't overwhelming. And the question is just how whelming or underwhelming it is. And I think there are other reasons to like Amazon. But yeah, this was a little bit of a soft report, I'd say.
So I want to get into those other reasons as well, but first, you noted the softness, at least in terms of how engaged people were with Prime Day and how much they were spending. Does that indicate to you this dynamic that the Washington Post laid out, where people felt like they weren't really getting a deal, so they opted not to really go all in on its Prime Day, or do you think it is the consumer getting weaker, and this is just the first indication of that?
It's very hard to know, Leslie. I imagine it's probably a little bit of both. But, even in our retail tracking that my colleague Greg Mellick on the retail side does, we're not seeing we're seeing a little bit of a slowdown in retail spend, but it's not dramatic. And Amazon is so big now, 10% of retail sales, kind of the same size as Walmart. If there really were a slowdown, Amazon would see it. So there may be a modest slowdown or maybe some uncertainty, and I guess that's the best read. And I'll just still stick with our survey work. I'm going to lean into that more than I will into the Washington Post article. All due respect to them. When we ask people where they get the best price and selection and convenience, especially on price, there's just no change. Amazon is consistently, and I think this is their algorithm. They price to tie the lowest price out there, and they've consistently done this for years, and I don't think that's changed. So I'm giving you a couple of different answers, but I don't think Amazon's pricing philosophy has changed as much as that article suggested.
Always worth noting, of course, Jeff Bezos does own the Washington Post. He is the founder of Amazon, still the chairman as well. Mark, what moves the needle for Amazon, though, is often not as much retail as it is AWS. And I'm just curious, what your sort of reads are right now in terms of margins there, given that's been such a focus for investors at in the company.
David, you're right. Look, we should change the ticker. It should be AWS, not AMZN. That's what's going to move the stock. If they don't accelerate AWS growth in the back half of this year, like Azure did, like Google Cloud did, the narrative that Google has really lost out or missed a lot of steps in this AI race is going to just get stronger and stronger. The stock is capped. We think AWS growth will accelerate. I'll give you four quick reasons why. First is that backlog accelerated the last 2 quarters. Last quarter, it exited at 25% year-over-year growth. That should be a good leading indicator. Secondly, the industry as a whole, we are seeing an inflection up because of AI in cloud compute, cloud storage needs. Third is the supply constraints that Amazon and other people have talked about, we think are gradually getting addressed, i.e. there's more NVIDIA chips out there. And finally, they've got this Anthropic deal. Anthropic seems to be winning the Gen AI enterprise race, at least for now. That's a major customer for AWS, and that should help with that acceleration. So we think we will get this acceleration. If AWS can exit this year, growing close to 20% year over year, this stock gaps up materially. That's one of the reasons Amazon's my #1 pick right now.
Yeah, obviously, we see the year-to-date performance. Hey, Mark, I like to take an opportunity when I see somebody who's been around for a while to sort of get your sense in terms of the comparisons that are often made now, this period versus the one we all lived through in terms of the internet boom of the mid to late 90s and into 2000. Do you see it? Is there anything concerning to you in terms of a bubble building, perhaps, in the broader AI ecosystem here that is in some way suggestive of what we saw in the late 90s?
I see one similarity and one difference. I'm going to drastically oversimplify. Here's the big difference. There's more cash on the balance sheets of the major tech stocks than there was market cap back then. I think that statement is probably true. If not, it's darn close to true. Hundreds of billions of cash. I mean, these companies are so profitable now, whereas back in the dot-com time, I think there was one company that I looked at in the internet space that was profitable. That was eBay, and that was it. And so, there's just the financial fundamental risk was so much greater back then. And so was the market risk. And so was the uncertainty over the management teams. You've got proven management teams now with huge, to die for balance sheets. And so that's the big difference. That's the big difference. The similarity is, I think some of this AI spending, I'm sure these companies, the management teams that I look at, I think have a mentality right now that the biggest mistake they could make would be to underinvest in AI. So that probably is leading to somewhat overly aggressive AI spend. But look, I'm seeing this return on AI. If you look at the revenue per employee of the four major hyperscalers, throw it in there, Microsoft, Amazon, Google, and Meta, revenue per employee has inflected up over the last 2 to 3 years. Part of that has to be efficiencies coming from AI deployments, and so that's. I hope I answered the question.
Yeah.
I think there's major differences and one or two similarities.
Yeah, no, you did. I mean, I think was it Sundar Pichai yesterday from Alphabet who said half their code now is being written by AI. It's being reviewed, he said, by humans. But I mean, that goes to your point in terms of productivity.
Yeah, we are. Again, I'll stick with this. You can look at operating income or revenue per employee. It is dramatically inflected up. It's gone up 30 to 40% for some of these names. And names like Meta, it's up 70% over the last 3 years. Now, there's a lot of noise in there. There's a lot of factors in there. And these companies, part of it is that they've really curtailed hiring. And so that'll increase your revenue per employee. Or they also fired people. I guess some of the people they fired must have been pretty inefficient. So there could be a lot of factors in there. But it's hard to avoid a conclusion that these companies aren't getting a better return on their AI spend, and it's showing up in that revenue per employee, and it's helping them develop better product for their customers, both consumers, us, and for advertisers. That's clearly the story from Meta, and that's why the companies, the market's giving them a little bit of a green light to continue to accelerate that spend. As long as that revenue growth stays high, they get the green light.
That's a good point. Mark, thanks so much. Mark Mahaney.
Thanks, Leslie.